I'm speaking with Phil Strano, Head of Australian Credit Research and Portfolio Manager at Yarra Capital Management. Welcome, Phil. First of all, thank you very much for participating in the Inside Network's Income and Defensive Assets Symposium.
Thanks, James. It's been a real pleasure to be here.
Phil, how are diversified, liquid, investment-grade credit strategies positioned to generate consistent income amid the current market volatility and really going forward?
Well, the easy answer to that, James, right now is very well positioned. We've got an environment now where we've got return in fixed income and credit, the likes of which we haven't really seen since pre-GFC, effectively. So when we look at our portfolios around kind of investment grade credit and just how well they're positioned, so running yields of kind of 6% or greater afford you with a real luxury of generating really attractive returns, but also being able to play a really strong defence. So that enables us to kind of have really defensive kind of income for clients through a cycle as we sit here right now.
What differentiates Yarra's approach to managing credit duration and downside protection?
Yeah, so we kind of focus on generating core income, which is that running yield. And all of our kind of credit research process is around kind of achieving the optimal blend of assets that we kind of focus on. The optimal blend of assets that kind of deliver the right style of return for the risk, and also always focus on providing optimal liquidity for clients as well. We then kind of think about the general kind of income gains that we can get from the whole research engine at Yarra, and it really involves around kind of using duration, interest rate duration strategically to kind of provide that kind of drawdown protection in times of risk off. But it also kind of enables us and gives us the confidence to then go and pick up those misallocated assets, mispriced assets during periods of risk off that then help us underpin that performance going forward with the next 12, 18 and 24 months and really help us kind of deliver those high risk-adjusted returns that our clients are after.
As an active manager, how do you add income and generate alpha?
We kind of focus on getting paid for the risk that we're taking, ultimately. And, the portfolio in terms of always focusing on a daily basis in terms of always, at the mantra is always, are we getting paid for the risk that we're taking? And on an individual asset basis, if we're not, then we sell it and we find something else that does. And that optimal mix is a clear focus for us, is maintaining portfolios that remain investment grade quality and deliver the best risk-adjusted returns that we can achieve for our clients through a cycle.
Looking at Australian and global credit markets at the moment, what structural trends are you seeing? Are we seeing different areas open up, different kinds of securities?
Yeah, James, it's a really interesting period. So the whole kind of de-dollarisation thematic that we're seeing or starting to see off the back of the unwinding of 80 years of the US dollar as the preeminent kind of reserve currency. Now, I'm not arguing that the US dollar is not going to be the reserve currency going forward. It is, but there's just less need for foreign investors to hold the same quantum of US dollars than what they've been used to over and built up over an 80-year period. And what that means is that we're going to see more allocation to other currencies than the US dollar. And that will have a flow-on effect to Australia. The Australian market is, in all intents and purposes, in the credit market, is the 5th largest market in the world. We are one of the few remaining AAA-rated countries in the world, very well regulated and politically stable, and an attractive destination for some of that flow that's no longer attractive to foreign investors to invest in USD. So what does that mean for us is that our opportunity set is going to increase significantly. So we're going to see a lot more issuance in this market, a lot more diversity of names. The ability for our market to actually sustain a much wider opportunity set is nirvana for us. It gives us the ability to kind of have a much wider variety of investment choices to continue to deliver for our clients in terms of high risk-adjusted returns.
For the advisors that are present today at the Income and Defensive Assets Symposium, Phil, aiming to achieve income for clients and wanting flexibility, how important is liquidity to them, in your view, in achieving those goals?
I think it's very important. I mean, liquidity is never really that important until you need it. And most of the times when you need it, other people need it at the same time. And if you haven't really invested in the right structures, chances are it's not going to be there. So, having that liquidity and being able to rotate It's very important to us to maximise risk-adjusted returns in the portfolio, being able to transition out of assets that we think are expensive or have credit concerns into assets that don't and offer higher returns. So from our perspective, being able to do that, it should be no different for an investor to have the ability to actually rotate into different assets from time to time, that by virtue of what's expensive and what's offering better returns. So it is incredibly important.
Phil Strano, Yarra Capital Management, it's a great pleasure having you here today and speaking with you.
Thanks, James. Really appreciate the opportunity.